This is Sunil Jhaveri, your host and host, also known as MisterBond in the mutual fund industry, welcoming you back to another episode of One on One with Mr. Bond in conversation with a very dear friend of mine, Akhil Chaturvedi. He is not only a business colleague, but I've known him for a long time. He is the director and chief business officer of Motilal Oswal Mutual Fund. Before I request Akhil to join us on the screen, let me tell you a few firsts for Motilal Oswal AMC. Not many are aware that Motilal Oswal AMC started with only equity as an asset class, as a mindset to manufacture and sell to the investors. That was the very first AMC who concentrated on equity as an asset class. Another first to them was coining buy right, sit tight, and bringing equity cult into the markets. That was as far as accumulation was concerned. Another first for the mutual fund house was that they coined another and started another campaign for distribution of wealth also, which was income B, wealth B. First of its kind in terms of declaring their investment philosophy from day one of starting of the mutual fund journey through their QGLP. So not many fund houses had actually communicated or spoken about their investment philosophy the way Motilal Oswal has spoken right from day one. Let me welcome Akhil Chaturvedi on the screen, please. Hi Akhil, thank you for joining us for this conversation on process to performance. So we are going to discuss about how you started with a bang. In between, there was some lull in terms of the scheme performances and how you're bouncing back. So the process is what you have put in place, how they did not work, and what is working currently is what we are going to discuss.
Yeah, hi Sunil. Thank you for having me over. It's a pleasure talking to you. Look forward.
So let me show to the viewers as to when you started, when you launched these schemes way back in 2014. That time it was, I think they were called Focus 25, Focus 35, and Focus 30, which was now the Flexi Cap, the Focused Fund, and the Mid Cap Fund. You had outperformed the benchmarks and the peers by a big margin. Let me ask you this question: is this only because you had investment philosophy which was written down, which was communicated to the mutual fund distribution community and the investors of QGLP, quality, growth, longevity, and price? Is that the reason why you outperformed benchmarks and peers in the initial stage of your launch of your AMC?
Yeah, so I would not say that because of having QGLP on our side, we outperformed. Uh, Obviously, you have to invest. You have to create a portfolio of. In our case, we look at focused investing. So, 25 to 30 stock portfolio, and out of thousands and thousands of listed companies, if you have to create your investment universe, and then within that universe, if you have to create a portfolio of 25, 30 stocks, obviously you need a process in place. Now, out of the experience of Mr. Agarwal, we had his philosophy, which he was practicing for his portfolio for many, many decades. And that is what we try to introduce in our AMC as a philosophy, which has to be carried forward. So, in simple terms, if you understand quality, growth, longevity, and price, all we are saying is that equity is a volatile asset class. It is subject to price movements. And as investment managers or custodians of investor, the first thing we have to do is basically protect the downside for the investors. Now, if you want to protect the downside of the investors, obviously you have to focus on quality, because quality will ensure that your downs are temporary and your ups are unlimited, right? So quality, while it looks very simple, but there are many things we try to look at when we try and understand the quality side of the business, which is typically denoted by return on capital. And then obviously very important to understand the management, right? So quality of business, quality of management, and 90% of the filtering out happens through the quality filter.
At the first instance itself.
At the first instance, let's say there are 6,000 listed companies, 90% are filtered out on the Q parameter. So it makes life very, very simple.
Wow.
Right? Then to make money, you need to participate in companies which will grow at a fast pace, right? So you define what rate you want to, grow your portfolio at. Is it 15%? Is it 20%, 25%? Accordingly, you chase growth, right? So when we talk about growth, we are looking at earnings growth, right? So quality check done, growth check done. We are buy and hold investors. Buy, right, sit tight is our principle. So longevity check is very, very important. So will the quality and the growth last for a couple of years, right? And
Right.
finally, quality, growth, and longevity, which is why you buy a certain business. The P is at what price you want to buy that business,
At
right?
what
So
valuation?
the
Are
end of
you willing to
the
overpay,
valuation.
or
So
you're trying to buy it at certain valuations?
yes. So the endeavor is always to buy good businesses, high growth businesses at a reasonable price. Uh,
Correct.
so there are a lot of measures what we track. Maybe PE multiple, maybe price to book, maybe DCF method, price earning to growth. So there are many valuation matrices which we try to track to assess individual businesses, their valuation, and the effort is always to buy uh, at the best possible price with the best margin of safety. And if you put all of these principles together, quality, growth, longevity, and price, it gives us a universe of, let's say, about 300, 350 stocks uh, at the AMC level. And then individual fund managers can actually create their own portfolio baskets of 25, 30, 35 stocks, depending on their own conviction within the basket of stocks. So now that was in place. Uh, in hindsight, you may say that uh, there are a lot of things which changed. In 2013 when we launched our first fund, and then in 2014 we saw there was a government change. In general, there was a lot of euphoria, and at that point of time, quality investing was a bit tailwinded, right? So we were in that bucket of high quality, high growth, and somehow all the quality oriented stocks were doing extremely well, and it lasted for several years. So it was not like a 1 year 2 year game, it lasted for almost 4 years. So between 2013 and 2018 is where our style of investing, which was high quality, high growth, was
It did
favorite.
exceedingly well.
It was favorable to us, and within that style typically you found a lot of consumer businesses, consumer discretionary, FMCG, banks, financials. All of these are considered to be high quality companies, uh, with secular earnings growth trajectory. It worked well, and we had a good 4 or 5 years of sustained outperformance. In fact, the outperformances were actually pretty alarming, honestly, right?
Very
So
alarming. In fact, that's what I'd shown at the beginning of the our interview.
yeah, so you may say that there was a element of luck factor also. You need that in investing. So we had the philosophy in place. We had a style in the works, and market supported our style, and we got lucky for 4 or 5 years, and what happened then, right? So
So what happened? So coming to the subsequent performance, which was an underperformance from 2018 to 2019, pre-COVID period. As the viewers can see this, some of your schemes underperformed the benchmarks also and the peers also.
yeah.
Now, and then during this period, let's put things in perspective. There was a polarized rally of 10 stocks in Nifty 50, but mid caps and small caps were bleeding during this period of 2018-19. So,
Yeah.
why did QGLP not work during these 2 years?
So so we try to assess this, and such that in future, if this kind of a situation happens, how do we navigate through? Now, honestly, what happened? If you remember, in 2017, it turned out to be the peak of the market. That is the time Nifty 50 hit the all-time high. Small caps were going through the roof. So small cap index also touched all-time high of some 9,500 points or so. So markets were very exuberant. Within the markets, our style was very exuberant, which was reflecting in the performance. Now, what had happened between 2016 and 2018 was two very crucial, critical reforms took place. One was demonetization. The second
Yes.
one was GST. Now, these two reforms, which was obviously very good for the long term of our economy, but in the short term, it had the impact on economy. It had impact on on businesses, and then obviously it reflected in the stock markets. So since 2018, from the apart from demon GST and then introduction of long-term capital gains, and then we had the ILFS crisis, and then we had the IBC reform, then we had the RERA reform. All of these things were happening back to back. Every quarter, 2 quarters, there
Correct.
was something which was coming, which was impacting the economy per se. And then obviously different businesses were getting impacted in different ways. So what happened in that time frame was that growth, as the economy slowed down, growth of the companies also slowed down. So when we went back and tried to assess what happened, what we saw was that price was not a problem at that point of time, despite outperformance. The issue was that the earnings growth trajectory actually slowed down quite rapidly. So what I remember a little bit is somewhere in 2017-18, the earnings growth at the portfolio level used to be like 25 to 26%, and this earnings growth came down to 3-4% in the subsequent financial year. Now, when the earnings growth slowed down, obviously the PE multiples also started to ease off, and that is what led to the slowdown of the performance or stagnation or underperformance, whatever. So that was the first thing. Growth came down. Like I said, we practice high quality, high growth. Quality was okay. P was not that much of an issue as long as the growth was coming. Growth came down, therefore the P multiples came down, and that was the start of that underperformance cycle.
Sure.
The second thing what had happened was uh, that, as you rightly said, in that year of 2018-19, the markets itself became very polarized.
Very
So
polarized.
while the Nifty was going up and the Nifty small cap was correcting, Nifty mid cap was correcting, only Nifty 50 was holding up or going up. And within Nifty 50 companies, there were only 15 stocks which were actually zooming off. It became
Absolutely.
extremely polarized in favor of twin HDFC Bank, twin Bajaj Finance, and a few more companies. Reliance Industries, I remember, it just went up three
So
times in
some
two
of these
years.
companies would not have made the filters in your QGLP. Is that what
Yeah,
you're saying?
for example, Reliance Industries, one stock, heavyweight in the index, uh, we were zero, right?
Okay.
So at that point of time, it was not really part of our universe. Uh, and so the largest stock in the index going up three times in, let's say, 2.5 years, and you have allocated zero, that itself became a big reason of underperformance, right? We did have HDFC Bank, HDFC Limited, Bajaj Finance, but those allocations were, or you can say they were, as compared to benchmark, it was lower, right? So we were not getting full participation on the other stocks, which was the HDFC and the Bajajes of the world, right? So
Sure.
so what was going up in the market, this polarization, and then ever since till date, also if you see, uh, generally the rally in markets have become very short-lived for certain sectors, for certain stocks, right? So the rotation of tailwinded stocks and sectors and themes and stories is changing very rapidly. This becomes a challenge for the long-term active investor, because we are trying to buy good businesses for, let's say, 3 year, 5 year time frame. But in that time frame, if the markets are rotating very fast, so then what you are owning in your portfolio and what
So
is
market
driving
cycles
market
had
can be
become
two
shorter,
very.
but so
Yeah.
coming to the next question, that this underperformance continued during COVID period and immediately post COVID also. Is that because of that buy right, sit tight philosophy of yours, which you were following, in which you would have selected certain sectors, but those certain sectors were not supposed to perform in a contractionary economies during COVID period, like BFSI or auto? So is that buy right, sit
Absolutely,
tight
absolutely.
actually deter your performances during this COVID period
In
also because
hindsight,
of that sectors,
in
etc.?
hinds yeah. So yes, in hindsight, you may say that staying put on financials, insurance, auto, all of these things did give us a lot of pain for a very long time, and all these things were going through painful period because of the IBC. The banking sector itself was going through an evolution. Auto sector, because of the BS4 to BS6 norms and the NBFC crisis, auto sector also went through a slowdown phase. Insurance also, due to the COVID issues, while we are very bullish about insurance sector as such, but for that period, insurance also underperformed to a quite a large extent. So yes, in hindsight, maybe uh, if we were a little bit more active in basically rotating our stock sectors at that point of time, maybe we could have handled this better.
So the question the question which comes to the minds of the investors and the MFDs is that were your fund managers not flexible enough? Were they not given enough leeway to change to the changing circumstances? As a fund manager, are they not supposed to only stick to that buy right, sit tight, but change based on the changing market dynamics, macroeconomics, microeconomics playing out at the ground level, etc.? So what kind of flexibility did the fund managers have at that point in time, is if you can just throw light on, and I'll speak about what has changed later on.
Yeah, so the fund managers have complete flexibility. That was never an issue. The issue was that some of our overweight sectors and underlying stocks, while like I said, the quality side of the business was looking good. Since these stocks had corrected quite sharply, the valuations were looking extremely attractive. The only thing what we had to see was the growth. Now, what we could see is that post-COVID, as the economy would recover, growth will come back, and therefore, at at a particular level, you really do not want to lose out of the crown jewels which have underperformed for some time. But it is quite visible that as things will open up, demand will come back, consumers will come back, and these companies will get back into the mojo which we are seeing currently, right? So we now that we lost out, we didn't want to further lose out by selling them and buying into something else which was working at that point of time, because at that point of time, if you remember, there was a huge rally into metals, there was a very longevity rally in chemicals, there was a very long rally in Reliance Industries, and all of these things at some points of time started being expensive. So the double whammy was that, do you liquidate what you own which is good but not performing, likely to perform in future, or do you sell that off and buy into something which has already gone up, and then obviously you go back into the risk on in the portfolio. So there is where the wisdom of Mr. Agarwal also comes in, our entire investment team, committee, etc., where we said, okay, maybe this is there for some time, let us just hold on, and eventually if the growth comes back, it will be rewarded, and it is actually playing out. The narrative is actually playing out. Now the question which you are asking is that uh, one should have had the vision that what is going to work in subsequent 1 year, 2 year period. Could we be a little bit more agile in
Maybe a
trying to
more
rotate our
top-down
sectors
approach
and
rather than a
stocks?
bottom-up approach during such
Yes,
periods.
yes, yes. So that was our learning. There were learnings, right? When
Sure.
you don't do well, is where you try to go back and see that what didn't work, and what needs to be done to ensure that the objective of investor and MFDs is to provide consistent returns over long periods of time.
Right.
So,
So just
what we
preempting your question and answer to your this thing, what were the learnings post this COVID scenario and post the underperformance, post the you sticking to buy right, sit tight in certain sectors during COVID period which were not supposed to work, etc. So I think you had created another set of investment philosophy. Winners you trim over valuations. Then there is another learning of laggards, double or quit. And the third one is exclusion mindfulness. If you can throw some light on all three of them.
Yeah, so I'll take few minutes to explain this whole thing.
Sure.
Between 2019 to till date, I would say, uh, we started to reorient ourselves to ensure that we have to achieve a particular goal. Now, the goal has to be defined first. The goal for the entire investment team was to, one, bring back our performance and then hold the performance in terms of quartile rankings for a longer period of time. Clearly, we wanted to move off from the camp of trying to be the best performers to moving into the camp of trying to be consistent performers.
Yes.
Now, when you have the goal in place, is where you can start to work that how will you achieve this. So when we
Right.
started to work on trying to achieve consistency over trying to be the best performer, is where we tried to fine tune our processes, uh, our investment frameworks, and put some very strong risk management frameworks to ensure that the portfolios are adequately priced at all points of time. So the
Correct.
growth check and the price check has to be monitored more uh, carefully and on an ongoing basis to ensure that uh, investors are not sitting on overvalued portfolios. So what we did was is that I put it this way, uh, that we made multiple changes at all levels. So first we made people level changes. So people, we we try to strengthen our investment team. From a 12-member investment team, we expanded it to a 30-member team. We try to build on capabilities to understand multiple sectors and not only few sectors where we were very, very comfortable.
Right.
So now we are very, very open to look at infrastructure. We are very open to look at metals, chemicals, uh, hospitals, new age digital businesses. So we build our capabilities so that we are not losing out on any opportunity which the market is throwing up at any given point of time. Right.
Sure.
So a lot of changes which happened at the people level, including we about a year back also had the privilege of getting Mr. Pratik Agarwal, as executive director to head the investments and help us basically bring about a lot more discipline and better performances going forward. So at all levels, we made a lot of changes at the people, and that is now looking perfectly fine with us. The second thing we did was at the process level. Now, at process level, I spoke about QGLP. I told you that quality we are looking at return on capital more than cost of capital. Now we are defining that as 15% at the portfolio level. So 15%
Okay.
ROE. Earnings growth, we are looking at 3% over the benchmark earnings growth. So that also has been defined. And P, which is the valuation, at the portfolio level, for simplistic understanding purposes, we are trying to keep our portfolios between 1 and 2 price earning to growth, which we feel is reasonable enough to hold on to your portfolio valuations and not going really on the over expensive zone. For example, paying a 50 PE multiple for a 30% growth company where the peg is 1.3, it is okay. Now, in
Right.
isolation, 50 PE multiple may look expensive, but when you join this with 30% growth, it will look very, very different.
What is
So
PEG? For
we
the
define
viewers' benefit, what is PEG?
price earning to growth. So
Yeah,
in
just
simple terms,
explain in
if you get a
layman's
company,
terms.
simple. So PE multiple divide by growth. So if
Sure.
a particular company delivers a 20% growth in profit and is available at 20 PE multiple, price earning to growth is 1.
One.
Now,
So
if the P
closer
multiple
to one and lower than one is
closer to 1, lower than 1 is where it is looking very, very attractive because you are
correct.
getting growth and you are paying much lower than the growth itself, right? And higher you keep going is where it is getting expensive. So we are saying that as the portfolios go beyond 2 is where we need to start acting in terms of, like you
So
said, booking
trimming the
profits.
winners is the first change which you had made is based
Yes,
on
yes,
this PEG and valuation
yeah.
index.
Yes. So we are a lot more mindful on valuations. We are a lot more mindful on the growth. And if either of these are not in our comfort zone, then we will be acting on the
So basically,
on the
you will
stocks
start
per se.
booking some profits based on the valuations which may become expensive
Yes.
according to the
Yes.
new
Yes.
changed
Yes. And if you
criteria.
go, yeah, if you go back 2, 3 years and you open up a lot of our portfolios, you will find that there are a lot of triggers and basis these new principles. We have been regularly booking profits in variety of stocks, and we are trying to protect the IRR of the fund. It's quite evident if you go into the portfolio and observe that.
So
So,
this is
so
as far as the winners are concerned. What about the laggards? You are saying that one not will.
I'll come to that. I'll come to this. So
Yeah.
we spoke about people, we spoke about process. Now within the process, QGLP is the way we buy a business. Why we buy a business, right? Because high quality, high growth at a reasonable price. But once you've done that, you need very strong risk management frameworks to ensure that you are not sitting on overvalued stocks, or you're not sitting far too long on dud stocks. You're trying to do some alignment with how the index looks like, and with the index how do we look like. So we try to work on all of these things, and then we defined, just like QGLP, defined our risk management frameworks very quickly. In the interest of time, what we are saying is that as far as possible, portfolio managers should try to have a equated portfolio. So if I'm having a 30 stock portfolio, 4 to 6% weight, now within the focus style of investing, we are not overexposing on the top end of the portfolio. We are not going to be underexposed at the bottom end. Since we are high conviction, bare minimum exposure has to be 2.5%. And as the stocks climb up and eventually cross 9% is where we will start to book our profits.
Trim down
So
your
trim down. So uh, minimum 2.5%, maximum 9. Try and be in the 4 to 6% band. So this is how we are trying to manage the weights of the stocks
Correct.
within the overall portfolio. Now, second thing is we said that uh, at some times you may tend to overexpose yourself to certain sectors or themes. So there, what we have defined is that for mutual funds, 7.5% deviation for any sector as compared to the benchmark. For my alternate products, it will be 10%. So you have
Right.
defined that how much over and under exposure you can, under allocation you can do as compared to the benchmark. So that's just a little bit of understanding what's happening in the benchmark and what are we trying to do. The
Sure.
third thing we try to do is that we will continue to be high conviction investors. So 30 to 40 stocks will be there, but we will manage our allocation in a way that you are not taking over risk in the portfolio. The second last part is basically your cut loss framework. Now, cut losses basically, there are times, there are black swan events, there are certain companies which where the prices fall down quite sharply, and if there is a trigger on the stop loss, then ideally the stock has to be sold out on the day one itself. Now, if the manager has some conviction, it may be a temporary downfall and he feels that the business is good and the price can come back, then what one needs to do is on day one you cut by, let's say, 20%. Quarter one, but active review on how that particular stock is doing in the next 2 quarters is very important. So if the company comes back and starts to outperform, you can continue with the position. But for next 2 quarters, if the outperformance is not coming back, then generally it will be a trigger for exiting the stock. So this is how you cut your laggards. On the top, I told you how we cut our profits. We're trying to
But
be
if they
more or less aligned with.
come back on track in the next quarters, you may want to double the exposure, is what you are saying. Cut your
Yes,
laggards,
yes.
right?
So we will be open. So all these risk management principles are guiding principles. It is not a quant model. It's not that if this will happen, this will get triggered. These are all guiding principles for the fund manager. And fund managers, obviously, in their review sessions with the investment committee, will take a decision whether they want to hold on to certain stocks for for some more time with detailed rational. Sometimes
What is
stocks just react.
exclusion mindfulness? What does that mean?
Exclusion mindfulness is basically we need to be mindful of certain businesses which are part of the index. For some reason they are into momentum, uh, and we are missing out because broadly it is not coming in our philosophy.
Like a new age technology kind of a
like
play?
like a Reliance Industries is where we learned this.
Okay.
Not owning Reliance was a big issue, right? So we try to understand Reliance Industries, but such kind of stocks, you need to have some allocation in your portfolio because they are. I mean, their allocation in the benchmark itself is very, very high. So not
Right.
owning does create some risk. So we will be mindful of certain businesses which are which have a higher allocation in the benchmark, which have may have certain tailwinds, and not owning, under owning them can create pain in the portfolio from a near term, medium term perspective. So be mindful of what you are not owning and what's happening in that space, and then whether are you consciously going to take it or will you not take it. That is a call one has to take. But we will be mindful of some of these names which may not necessarily be coming into our universe, but we may still end up owning because of the index alignment within the portfolio.
Sure. What about the new age technology also? There also there is no track record. So this does that fall part of this category of exclusion mindfulness?
No, new age technologies has been more of a it has been more of a uh, I would say it's more of a fundamental call we have taken.
Right.
You will remember 3 years back, Ramdevji actually did a wealth creation study, atoms to bits, to understand. We could figure out that this is a absolute brand new opportunity which is getting created. A lot of these companies were planning their IPO at that point of time, and
Correct.
it made sense to understand these businesses and whether these businesses will become big, profitable,
Because you don't know
can
which
they
will
make
be
a
the
lot of
next
value.
Amazon in that out of that
Absolutely,
basket.
absolutely. So we did a lot of we tried to do a lot of understanding on these businesses. We spoke to their managements. Then their IPOs came. We did little bit of experimentation during the IPO. We did not go overweight. But early this year, when these stocks had come down quite drastically by 50, 60, 70%, is where we were getting guidance that these companies are now planning to get into the profit mode, loss to profit. You know that Zomato has now declared a 24 crores profit at the EBITDA level. Paytm also is making profit. It has made
Yes,
profit in the last quarter, and their guidance is next 2 years. We feel they can do much earlier. These companies were changing their business model to align with the shareholder expectations that eventually they have to make money and stop burning businesses, stop burning money, right? The other thing was that the change of ownership from short term or bad owners to good owners, because those PE kind of investors were moving out, and domestic investors, institutions were buying it. So you generally move from short term to long term investors. So we
correct.
feel that digital technology oriented companies uh, will be a fundamental bet. Maybe here is where the buy right sit right will come in play, because these businesses you can't look at from next 1 2 3 year perspective. You have to have what kind of opportunity size will be there for these businesses after 10 years, right?
Absolutely.
So we took the opportunity of the price correction. So at least we have ensured that we have come hopefully at the right levels.
Right.
We are seeing that turnaround is happening. We've understood the challenges, therefore we are much more close in terms of tracking these businesses, talking to their managements, understanding the landscape. But we do feel that it's quite possible that in the next decade or so, uh, few of these businesses could be very very large businesses, and uh, could be part of the top 100 market cap club also. So that is
So,
a
Akhil, I
it's a
think what we
fundamental
are
point.
seeing is, all these changes which you have come about, the learnings from your past mistakes, changing your investment philosophy, or not changing, but tweaking the investment philosophy to be a little more flexible.
Yes,
That has
yes.
started bearing fruits, and practically all of your schemes are in the top quartile, or they are actually the top performers in each one of their categories, like large and mid cap, your dynamic asset allocation fund (BAF), and so on and so forth. Uh,
ELSS.
yeah, so NELSS, of course. So those are the ones who are absolutely on target. They have turned around. They've started performing extremely well, all on the top quartile and top, performances also. Now, do
Yeah.
you have you, through these changes and the learnings, converted your style from just bottom up stock picking to top down also, and bottom up as a combination, or you still sticking to bottom up through the QGLP?
So bottom up is the core, right?
Right.
How the businesses will deliver over next 3 year, 5 year is the core to any fundamental investing. But yes, we are a lot more aware of the top down opportunities, and top down can be defined as some of the. So we have defined 8 or 9 themes where we feel that there will be higher tailwinds in the next couple of years. For example, within the healthcare sector, we are over allocating ourselves to hospital businesses or pharmacy chains. Within the banks and the financial space, we are over allocating towards the mid-sized banks or the NBFC space, because we feel the growth will go there from the large cap banks. We
Right.
are looking at defense much more aggressively. We are participating in the defense story. We are looking at China plus one theme, which will play out through chemicals, garments, so on and so forth. So we have identified some of the macro themes where we feel the tailwinds will be there. Then we are also trying to spot opportunities in the market cap buckets itself. So if you
Right.
see a lot of our portfolios in the financial year 22, consciously we had reduced our allocation to large caps, and we had increased our allocation towards the small caps. So the mid and the small cap portion, if you see our flexi cap fund, large and mid cap fund, typically you will find more like a 50-50 kind of a exposure to a between large cap and mid and small caps. So we have taken those calls. We will continue to monitor top down also, but eventually the core of investing will be fundamental. So I would say that it will be a combination with fundamentals, let's say 60%, 40% thematic opportunities, and any other opportunity. It could be a short-term opportunity, it could be a cyclical opportunity. Uh, we will be tracking all of these things.
Now, tell me, through the learnings during COVID period also, what kind of flexibility have you given to your fund managers? Going forward, you have defined certain mandates, you have defined certain sector allocations, you have defined certain stock allocations, and how they breach those allocation levels, and you will have to bring them back. So where does the fund manager have the flexibility to deviate from these mandates? And if they deviate from the mandates, what are the checks and balances for them?
So the rules of the land has been laid down, right? And if you
Have
uh,
they become more stringent or have they become more flexible in favor of fund manager?
so it is not on either extreme. It's not
Okay,
very stringent. At the same time, it is not extremely flexible, right? Like I said, the goal is basically to bring about consistency. So you need to
right.
have the frameworks which can give you consistency. Now, in order to achieve that, we have put down some rules, policies, processes in place. I feel that enough flexibility has been given, and like I said, a lot of things can be worked out on exception basis if there's a very strong logical argument between the fund manager and the investment committee.
Any
So the
recent
investment
example?
committee is
Any recent example you can share
um,
of
now I
deviation?
don't want to go I do not want to go into the stocks and all of
Okay,
those things, but we have allowed, let's say in the mid cap fund, for at various instances we allowed the manager to passive breach on the 9% cap in one of the stock, which was, let's say, Tube Investments, because that's been a multi-bagger in the stock. The manager was uh, expecting some more movement, and therefore that passive breach was allowed, but of course now he's come down. So there have been instances, honestly, without getting into the specifics, I would say there are instances where exceptions have been given, flexibility was provided, and that is the beauty. This is not a quant model.
correct.
It's there are frameworks, and if something, now you see digital technology companies, now typically it doesn't work in the framework. I mean, if you look at the growth loss-making companies, PE multiples look very elevated. So this is clearly a thematic deviation we have taken at the fund house level itself. So that's a
Correct.
flexibility. We have not
Right.
stopped anybody, or we are not pushing anybody. So a lot of managers are participating in that opportunity, and a few are not participating, right? So uh, again, I would say that we have a very strong, while we have put in processes, we have very strong individual capabilities between very strong investment committee, which comprises of Ramdev Agarwal, Naveen Agarwal, Pratik Agarwal, incidentally all three Agarwals, and
They're not
a very
related, by the
healthy,
way.
and not related, and a very healthy uh, you know uh, debates happening between both the sides, uh, for and against any particular business. From time to time it may happen. So but yes, broad basis, rules have been laid down. There are extreme strong uh, systems which have been created to ensure that everyone is in line. At the same time, there is always a room for flexibility at different points of time. Many times what happens, if I take 30 seconds more, managers come up with their own ideations, right?
Okay.
Those ideations may be anti-consensus, or it may not be part of the universe.
Right.
So the IC is very quick to get into a healthy debate, understand, do management meeting, this, that, and if the conviction is very, very strong, we allow that flexibility to quickly
Perfect.
include that stock into the universe. So a lot of action, honestly, between that 14 to 18 and the current phase, there is a lot of
So lot of
momentum
changes
out
have
here,
happened. So
a lot of
that's what is showing in your
activity.
performances also. That's what we were discussing. Process
Yeah.
to performance, and that process slowly and steadily, which has evolved over a period
Yeah.
of time. And fortunately, as a fund house, you have understood that there were some changes required. You've not been stubborn in not given leeways and done some changes to your investment processes, etc. And fortunately for the investors, for the mutual fund distribution community, you have finally shown results also. Now, last
Sunil, I'll
question to
just
you
say,
is,
Ramdevji
sure,
says one thing: in investing, you have to be learner every day.
absolutely.
People have perceived us to be rigid or stubborn in terms of changes, but honestly, I have been here and I've seen all changes happening out here. Even when we did not perform, I did not face any kind of a feeling that there is a resistance, that no, this is only what we will do, we will not change, we will follow. There
Even
was
if you have
nothing like
not
that.
performed, I think the processes were strong enough for you to have selected the right stocks, which would have panned out at some
Yeah.
point in time.
Yes. So It was just that it took us some time to reorient, realign, and then reflect that into our portfolios, and then wait for the markets to give the results, which has just started to come in the, let's say, last 18 months, is where one after uh, one or the other schemes are coming back into the top quartile. So we were always open. First, we had to understand what did not work. Then we had to change to arrest that, and then it had to reflect in the
Correct.
portfolios. And now it is reflecting in the
If
performance,
Warren
and it
Buffett
is
can change their investment style and thought processes on investing in, say, Apple or an airline industry,
yes,
that itself, because Ramdev Agarwal is an ardent follower of Warren Buffett, and so are all of us. I'm
yeah.
sure,
So they say
we
that
all have to learn and
only
be
change,
flexible.
only thing which is constant is change. So we are very open to change. We are not rigid.
No, no,
We are
glad to
very
hear
flexible.
that, because the fund manager bias is sometimes becomes very sticky, and stubbornness to it goes towards the stubbornness side also. But I'm very happy to hear from your fund house that you are ready to change. You actually made changes also based on your learnings from COVID and pre-COVID eras also, and it's
And
it's all showing. Now
we've
the
also
question to
we
you
have
is that
also we have also produced a lot of talent in our fund management team.
right.
So if you see, Aditya Khemani has done a wonderful job. He's just been
I've
4 years in the
interviewed
system.
Aditya Khemani also, and I've
Yes,
interviewed Niket Shah
yes.
also. So Aditya Khemani
Niket Shah
manages
was
large
a,
and mid cap, and
yeah.
Niket Shah I think manages mid cap and now
Niket
flexi
was
cap
the
also.
co-fund manager with Akash, and once Akash left, and he's demonstrated his stock picking skills,
Correct.
following the frameworks, and sustaining his quartile rankings for now almost 14 quarters. Right. On the alternate side, we have Vaibhav Agarwal, who's done a phenomenal job in managing our alternate investment funds. We have Atul Mehra, who's done a phenomenal job in managing one of the PMS strategies. And there also we made several changes. So for us, we are one house uh, across alternates as well as mutual funds, one style, one philosophy, common pool of talent, and the common goal, again, I want to reiterate, is that we are moving towards sustaining our quartile rankings rather than trying to be the best performers. Uh, if just in case we become number one, two, three, it is sheer luck. That was not by design.
Absolutely.
Maybe somebody else has gone down. We are one,
I've
but we are
always
not
believed in
targeting
that,
to be.
that don't chase performances. It's try to be consistent, and that's what I think your fund house is also trying to achieve. Now the question
I
is,
just want to
you
clarify
have a
through your
focused
platform.
approach of 25 to 35 stocks versus the general approach of having 55 to 75 stocks in each scheme. You can
Yeah.
afford to be focused currently because maybe your scheme sizes are not large enough. But once your scheme sizes grow, A, how will your focus approach change? And B, currently, since you have a focus approach of 25 to 35, is it pure and sheer conviction of those stocks that is making you go through us towards the focused approach? What if those bets don't pan out because it's a concentrated portfolio in a certain way?
Which is what I clarified earlier, that there's a perception that if you have a 35 stock portfolio, which means you are a concentrated portfolio and therefore more risk. To arrest that is where I said that we are trying to spread the risk across the 35 stocks by trying to have equal weights
Right.
between 4 and 6%. The risk comes when your top 3, 4, 5 stocks are equivalent to 40-50%.
Correct.
But if your entire portfolio is in a comfortable 5 to 6% band, then you're okay. So you just have to manage your allocations properly,
Right.
right? Uh, so you can comfortably manage through the focused or high conviction style of investing. Uh, we have stopped calling ourselves as concentrated investors. If
Okay.
you have heard the last 15 minutes, I've been using two words: focused investing, high conviction investing. We are
Correct.
not talking about concentrated investing.
Absolutely.
So our portfolios are high conviction portfolios and not concentrated portfolios. And if you are giving money to active managers, and I create a index replica with some underweight, overweight positions, then I don't know what kind of a edge we are trying to do. Whereas while that style is also good, and that also delivers results, I'm not for and against that style. We feel that this is a good way to offer investor a unique style of investing, and over long term,
Will this change with the changes in your
We will assess. We will
AUMs?
assess. We will assess.
Because you may have to go beyond 25, 30 focus stocks to maybe more because of the sheer size of the portfolios also going forward.
We are open, Sunil. So
Okay.
when that will happen, we come at that stage. If we have to take it up to 40 stocks, we are open. Like I said that you know we will cross the bridge when it comes, right? So at this stage we are okay, but we are open.
Great. Now let me share some of the performances. I'm not in favor of point-to-point returns generally, but let me share with the viewers the point-to-point returns of last 1 year of some of your schemes, so they understand how this process to performance has been delivered. This is your last 1 year large and mid cap scheme, which is number one performer out of 26 odd schemes in that space.
Call it quartile one.
Right now, of course, you may want to call it quartile one, but last 1 year performance, it's actually turned out to be number one. Again, mid cap fund also is the top quartile, fourth out of 25 schemes. Flexi cap has some way to go, which I'm sure will also start catching up. I'll ask you a few questions on that also. And your dynamic bond fund, which is the balance advantage fund, also has become the top quartile performer. It was a laggard for quite some time, but I think Santosh Singh taking over and his style of investing has also started showing results in the performance of balance advantage fund. Now, your last thoughts on your flexi cap, and which has started to climb up the ladder, because last 1 month, 3 months, 6 months, if I see, it has performed very well and it's in the top quartile. Maybe last 1 year, it's still catching up. So your thoughts on flexi cap and as to what changes you've made there, and what should the investors expect?
So in flexi cap also, number one, we have given one of our performing managers, Niket Shah, who's managing our mid cap fund. He is now leading to manage the flexi cap fund. This has been, I think, just about 9 months or so, when he took over the fund. He has very swiftly made all the changes in terms of giving exposures to new stocks, changing the market cap allocation itself, because in flexi cap typically you will find a lot of over allocation towards large cap. I'm happy to say that our large cap allocation within the flexi cap fund is now come down to 48%. So 52% of our portfolio,
The
which is
industry average, by the
8,000,
way, is 65% in flexi cap, in towards
65.
large
So
cap.
we are tidbit below 50%. Right. So
Correct.
what we have changed is basically we have moved from a low medium growth portfolio to a high growth portfolio, and hoping
Sure.
that high growth will give me faster or a quicker kind of a outcome, so that I can revive my the painful period of underperformance what we are seeing. So
Correct.
we have just changed the growth quotient, honestly, which is reflecting by refreshed portfolio, refreshed allocation between market cap buckets. So now Q is in place, growth is in place, the repair work has been done. We are seeing that in a typical analogy, the patient has been operated upon. The patient is out of the bed and is walking. It
Recuperation.
is it is walking. It will jog and it will sprint.
Sure.
I can't define when it will come back, how it will come back, and how much it will come back. But I feel that the worst is behind us, and incrementally we are seeing the early signs of outperformance on a FYTD basis, 1 month, 3 month, 6 month basis. But too early to make any prediction. We just need blessings from everybody.
Sure.
And just like what we have demonstrated in our larger mid cap ELSs, I'm sure that if things have worked out well for those funds, I don't see any reason why this will not work. So
Absolutely.
it's just वो हिंदी में बोलते हैं कि हाथी निकल गया पूंछ बाकी है. That's
Who's
it.
back here?
But
Thank you
let
so
me
much, Akhil, for a very candid interview, process to performance. And, I must thank you and your AMC for delivering immense wealth for the investors and the mutual fund distributors also. So
thank you.
I hope that you continue on this path of flexibility, adaptability, changing with the times, and finally trying to remain in the top quartile, not necessarily the top performer. So that's what we are looking from Motilal Oswal Asset Management Company. Thank you so much.
No, thank you, Sunil. My last comment will be to all the mutual fund distributors who follow you, who watch you, is that uh, we are committed. We are putting all our best efforts, whatever we know, to ensure that we revive the performances of the portfolios where still some pain is there, and some of our other portfolios which are doing well. These are only early days, so
Sure.
possibly we feel that next few years will be in favor of our style of investing. Portfolios are looking very, very fresh. A lot of uh, distinction in terms of the underlying businesses if you compare with competition portfolios. So we are giving you that differentiation. We are giving you redefined philosophy, processes, much more stronger risk frameworks in place. And thank you for being supportive of us in the bad times. I'm sure we will make it up in the near future for the
Always,
patience you've
always.
kept.
More power
Thank
to
you.
you, your team, and your AMC. Thank you.
Thank you so
Thank you
much.
so much.
Thank you, Sunil.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.